Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. The national debt is quickly approaching $36 trillion, according to the U.S. Treasury, a fact that has fueled concerns among investors and economists. This means that the federal debt has nearly quadrupled since before the 2008 global financial crisis and has grown every year since 2001. How can investors put government spending in perspective and stay focused on what drives markets in the long run? The national debt has grown rapidly since 2008. The debt ceiling, which is the maximum amount of debt the federal government is allowed to borrow, becomes a key issue when it's reinstated in January 2025. These concerns should be distinguished from whether the federal debt directly or indirectly impacts the economy and markets. Without diminishing the importance of the national debt, we need to keep in mind that markets have generated strong returns over the past two economic cycles. Investors should avoid overreacting with their portfolios at the expense of their long-term financial plans. The size of the national debt relative to the size of the economy provides a clearer picture than the dollar amount of debt alone. There is no getting around the fact that the national debt has grown significantly, but the economy has also doubled since 2008. The U.S. economy is more diverse, demographic trends are much more favorable, and the dollar plays a far more important role in the global economy. Large budget deficits each year have driven up the national debt. How has the federal debt increased so quickly? In two words, budget deficits. Budget deficits occur when the government spends more than it collects in taxes, which adds to the total debt. Even though tax revenues tend to increase as the economy grows, even without raising tax rates, they have been outpaced by government spending over time. These expenditures have grown across what are known as mandatory programs such as Social Security and Medicare, as well as so-called discretionary items such as defense and education. History shows that over time, deficits improve as the economy stabilizes, even if they don't turn into surpluses. The debt burden will only grow as interest payments rise. The last balanced budgets occurred from 1997 to 2001. The accompanying chart shows that left unchecked, government projections suggest that interest payments on the debt alone could rise to $1.71 trillion in 10 years. Many investors worry that growing debt levels means that treasuries could be less attractive in the future. In the extreme, this could hamper the government's ability to roll its debt, possibly leading to skyrocketing interest rates or weaken the dollar's standing as the world's reserve currency. Ultimately, many worry that the U.S. could lose its position in the global economy. While this is possible, it does not seem likely just yet, even with increased enthusiasm for dollar alternatives such as cryptocurrencies and gold. In fact, this has been a concern among economists for many decades, and yet, when the global economy faces distress, investors and governments turn to the U.S. as a safe haven. Finally, and perhaps most importantly, markets have done well, regardless of the exact level of the government debt and taxes over the past century. Ironically, the best time to invest over the past 2 decades has been when the deficit has been the worst. These periods represent times of economic crisis when the government is engaging in emergency spending, which tends to coincide with the worst points of the market. And while this isn't exactly a robust investment strategy, it does underscore the importance of not overreacting to fiscal policy in one's portfolio. The bottom line? The federal debt is a complex and controversial topic. As with many heated issues, it's important for investors to separate their personal concerns and not react with their hard-earned savings or investments. Thank you for listening. For additional information, please visit MRAadvisory.com.